All right. Thank you, everybody, for being here today. This is Dan with TrendSpider, and I've got a really special guest, somebody who I have followed on X for years, and somebody who's been right more than he's wrong, especially lately, and somebody who I have a great deal of respect for, Michael Guyad. Michael, thank you for being here today.
Let me know where to send the check for you to say that I'm right more than wrong, because a lot of people disagree with that
Well,
statement.
I think that's the beautiful thing about the markets, right? You can be right, you can be wrong, you can be early, you can be late, right? And you can have a variety of different people who are correct all at the same time, but on different time horizons. So, I think you've been pretty spot on, especially as of late. And I wanted to dig in and understand, how you came to your conclusions, and some stuff like that. But maybe really quick, just give us a quick, brief intro. Tell us about yourself.
Yeah, I appreciate that. So I'm involved in three different business lines, and I've been in the business for some time. But one is I'm a fund manager. I have a mutual fund, two ETFs, and a new ETF that's going to be launched and seeded on June 9th and launched effectively trading June 10th, focused on deregulation. So I have that kind of fund world. Um, Second thing is I have a media and content business line engine called the Lead Lag Report. That's where my social media posts are. That's where the Substack writings are. That's where a lot of the kind of visibility comes from. And then the third business line, which has really kind of exploded the last several months, is with a great partner, Mr. David Durking, work with various fund issuers, helping them in terms of content generation, in terms of getting them in front of different possible audiences for them to grow their own brand awareness and books of business. And that agency model is actually done quite well. We've got 23 fund companies, some very large firms that we effectively power the content of that most people are not aware of in terms of us being on the back end, which is interesting because it does confirm this idea that we are in a world where people want to look for thought leadership and don't want to be given fact sheets. Right? They're looking for ideas. They're looking for authenticity. They're not looking for to be sold to. Right? And a lot of the industry, believe it or not, doesn't know how to go about that. We do.
That's cool. So, I know we're limited on time, so I wanted to dive right into the meat of it. You've posted a lot online about how your view is that they being the Fed, the government, whoever, will have to kill the stock market to save the bond market.
Yeah.
I wanted to dive into that and just kind of maybe you can explain what you mean by that, and then we can talk about it a little bit more.
Yeah, and to be clear, and I have no problem saying this, that comes from a bit of a biased perspective because I do want to see volatility in equities and markets go down to spark a flight to safety into treasuries because that's the kind of environment I created my existing tactical funds to benefit off of. So I
Okay.
am biased in that sense. My funds are rules-based tactical. They're not based on my opinion or thinking, but they need a certain cycle. And this has been a very bizarre cycle because the risks have clearly only been in the duration side of government debt. It has not manifested in equities in a persistent way or junk debt, which is the real conundrum, I think, relative to small caps, which we can touch on. So the basically what I'm referring to is just a pure statistical fact, which is that if you look at historically the biggest declines in the stock market any single day, typically treasury yields will drop and drop hard on those extreme down days for markets, right? And why is that? Because extreme down days for markets suddenly puts into question the viability of the default rates being maybe wrong, right, in terms of corporate credit. Volatility in equities translates into credit spreads widening historically. Credit spreads widening tends to cause that flight to safety into treasuries, causing yields to drop on government debt, which basically gives then the government conceivably a lower yielding environment to refinance all their debt into, right? So it's like if you want to bring yields down, you have to cause demand for treasuries to go up. If you really want to cause demand for treasuries to go up, you have to scare the shit out of stock market investors.
For them to rotate into
But like
treasury.
heroic, right? Or for a moment in time, and obviously junk debt investors as well, because why I always go back to that term risk off. What is the risk that's off? Like you hear that term all the time, risk off. Well, it's not there's no risk. The risk that's off in the term risk off is default risk off, which is what causes the flight to safety. What's the safety? What does that word mean in flight to safety? Safety into U.S. government treasuries because you know you're going to get your money back because the government's got a printer.
Hmm.
Like, I mean, that's what
What,
that
why do you think the opposite has kind of happened, where you've had equities and yields both go up at the same time?
because the government's got a printer. I mean, that's kind of the issue, right? It's like because we got to a point now where post-COVID, everyone's the government's basically doing wartime type spending.
The
You know,
cure is the disease, essentially.
yeah, well said. It's exactly right. Right now, but at some point, I think that has to reverse. And I've flagged the Japan dynamic for a long time now, coming up on 2 years. I've been arguing about this reverse carry trade risk condition that's out there, which now you're seeing it. Yields are spiking in Japan in a way that's very, very disturbing if it were to continue at this current pace. And I think that does spark inevitably, the cure being the cure again, as opposed to the cure of money printing causing the issue of rising yields. I just think that at the end of the day, they have to sacrifice stocks because at the end of the day, the bond market. Somebody said it to me on X very well. I don't remember who it is, but I'll steal the line. Something along the lines of the stock market can break the economy. The bond market can break the government, right? And the moment you have that framework, can break the system. It tells you that between the two, bonds have to be saved.
It's fascinating. You see, I didn't realize this until recently, but Japan sells 40-year debt. So
Yeah.
spikes in yields, they don't just affect it now. They'll have a lasting, lingering effect for a long time. So I'm curious, during the Biden administration, Secretary Yellen prioritized short-term debt over long-term debt.
Yep.
And the Trump administration has continued that, right? Where they've issued a lot more short-term 3, 6, 1 year bonds than 10 years, 30 years. That seems to be biting everybody in the butt right now. Wouldn't you say? Or how do you see that playing out in the future? Like, do they push yields down by hurting stocks and then start focusing on long-term debt again?
Could be. Part of this may have to do with how deregulation impacts the banks, their mandated requirements in terms of how much treasuries and what duration they hold, right? In terms of the leverage ratio requirements altering, which is what Besant's been kind of alluding to on the deregulation side. So it makes sense. I will say that that's one thing that I myself missed or underappreciated in this cycle, which is that I thought all along the fastest rate hike cycle in history would have this huge lag, create a credit event, because that's typically what happens. The Fed moves late, it overreacts, and then you see the after effects on some long and variable time frame. I did not think that at the same time the Fed's going through the fastest rate hike cycle in history, Yellen would be playing games and liquefying, right? So it's like you're taking liquidity out with the left hand, you're putting even more in with the right hand, which explains why you had this yield hike cycle with financial conditions getting looser. It was the Treasury side countering the Fed. The government was countering the government. I don't care what people say the Fed's independent. Yeah, the Fed's the government too, right?
Yeah,
It's the government because they're buying treasuries. Okay, so don't tell me they're not the government. Okay,
the
but that
snake's eating its own tail, so to speak.
yeah, exactly right. But that game can only be played for so long until there's really nasty ramifications. And the nasty ramifications are another resurgence of inflation, which if you look at inflation expectations, you look at true inflation numbers after having, they look like they bottomed out and now are picking up again. Part of that's tariffs, but part of that is also probably the lags of them still spending like drunken sailors. Doge, no Doge, it doesn't matter,
I
right?
think drunken sailors probably have more discipline than the government.
And more fun, let's face it.
Yeah,
A bunch of
definitely.
sad people in politics.
So let me ask you this, because a lot of our audience, a lot of the people listening to this, they're equity, they're options traders, right? They're retail people, and they're just trying to make a living in the markets.
Yeah.
So when people talk about having to kill the stock market to save the bond market, that obviously scares a lot of them.
Yeah.
And I think there's this air of euphoria right now, right? Perhaps the calm before the storm, perhaps the calm before the biggest rally of our lives. Nobody knows. But in your opinion, what does that actually mean? How do they kill the stock market? Where does the stock market go as a result of their actions?
So, and again, this is a part of, I think, of the misunderstanding of my whole thesis all along.
Okay.
And so go back to the pure stat fact that big declines tend to cause inequities in stocks tend to cause yields to drop. tend to cause rates to drop, which again makes sense because the reverse wealth effect, it's a disinflationary, deflationary effect when that happens. Okay, whenever that happens, after these big declines, the washouts, the capitulations, the crashes in equities, there's a period of volatility, bottoming out, and then a recovery. Because we know markets historically tend to go higher over time. On a long enough time frame, you'll survive crashes, right? As long as you have a long enough time frame. Okay.
And the patience. But tell that
And
to
the patience, right?
American investors from 2006, right? Who are
Yeah,
still
no, but sure, sure, right, exactly. Right. So there's a it's just a matter of the time component. But the bigger dynamic which is missed in that is after that, historically, again, it's fact, it's not my opinion. When the market goes down heavy and then yields drop in that, as the market is rebounding, guess what happens to yields? Yields keep drifting lower.
interesting.
This is what's missed by a lot of people that are not understanding my thesis because they're getting too sucked up on the word crash.
Why is that?
It's almost like there's this persistence that happens in the bond market, in the treasury side, whereby yes, the market may be rebounding, but because a lot of people may have sold the low, it's not like everybody is able to benefit from the rebound. So there's still a lasting disinflationary dynamic that takes place.
Interesting.
Right? That's at least my theory on that. But it is categorically true that after crashes in the stock market, where yields then respond by dropping, yields keep tending to drift in that dropping direction, which goes back. So it's like you need to have the shock, right? Market's going to rebound, but then yields keep on going lower. So that's really, I think, the play, if in quotes they want to play that card. Break the stock market for a moment in time to start the drift in yields lower, right, for them to refinance into. And the stock market itself will then rebound, but yields will keep on giving them that wiggle room to then refinance into cheaper financing rates.
So I got to ask then, because I'm very curious about this. Why do you think that didn't happen?
Yeah.
Because the Liberation Day, or as I like to call it, Liquidation Day, tariffs, they spooked the market. I remember it like the day my son was born. Like I'm watching this thing just go up, 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 and then straight down. And my natural inclination was, okay, look at yields, and they're doing the kind of opposite of what I expect. It was very kind of jarring.
Yeah, which is actually interesting. So it's nuanced because in the first part of that, let's call it tariff tantrum, it's true that treasuries actually did act risk off, meaning you were seeing as volatility was rising, it was very slight, but you were seeing yields dropping on the long end.
We had the three print for, a
Right.
split second.
First, and then suddenly Treasury sold, prices sold off and yields rose in the latter part of the sell-off. So it's like it's like that flight to safety behavior was starting to come in, but then it reversed. Now, my thesis on that is some people will argue it's because of the inflationary aspects of tariffs. I think it was really about Japan, right? And
Okay.
I kept on saying that on X. I think this is not about tariffs; it's about Japan because as this is happening, the yen is moving. As this is happening, yields in Japan are rising prior to our yields were rising. And there was that story, I think, by the Financial Times that in a 2 week period, Japan sold the fastest clip of treasuries they've seen since the recorded history during the tariff tantrum. So then it just becomes a mechanical issue, right? It's like they unleashed supply, whereas the flight to safety was starting to assert, but they just countered it with a wave of unloading of their own treasury holdings, which is basically the reverse carry trade thesis, right?
It is.
Playing out for a moment in time to sell treasuries, to raise dollars, to ultimately then support the yen, to
How do
counter
you
the.
how would you explain the yen carry trade to just a regular retail trader? Because it's kind of a esoteric, complicated thing. I don't think a lot of people understand it.
Few do. Yeah. So what I would say is, I mean, it's conceptually not super challenging until you start talking about the currency component, but money freely moves, right? So why in the world would you want to borrow money at 3, 4, 5% when you can get it for basically free from Japan? Like it could for a number of years.
So they
So
borrow from Japan and then
literally
they
borrow
buy
from Japan.
equities or whatever with it.
Yeah, and make the spread, right? So and typically they would do that in other safe assets because it's still a loan that you owe in the Japanese bank, let's say, right? Now the thing is, when you're doing that in their currency,
And their
right?
currencies fluctuations will affect your trade.
Right, exactly right. So if the yen is weakening against your currency, you as the borrower of that money in yen like it because when you pay back that loan, you're paying it back with your stronger currency. Okay, which means that whatever set dollar amount you borrowed from Japan is actually less when you convert the currency. And it's like you're actually making money just from the currency side, helping you out in terms of the liability being lower on a after currency conversion basis. If the yen's rising and doing so precipitously, that then becomes a problem because now that loan's actually is actually more expensive because you need more of your currency to convert for the fixed yen amount that you borrowed from Japan. And that's the reverse carry trade that creates the sort of panic. Everyone sells off where they put their leveraged Japanese loans because the currency is running away from them. And that sparks the sort of the event, right? This has always been my thesis, which you saw for a moment in time, August 3rd, August 5th, right? With everyone freaking out, everyone looking at my X feed like, oh, he was right all along, and I got 15 million impressions organically that single day, and I said that's probably a low because everyone now is an expert in it. But the
Yeah.
fact that everyone now thinks that it's over, it doesn't make sense to me. It's like the carry trade must still be happening because it's still profitable. As long as something is profitable, trade greed means traders, investors will keep doing it. So we're still in the dynamic where there's a risk that money is borrowing still from Japan, and there's a risk that if the yen runs away on the upside relative to the dollar, that yes, you could have a repatriation of that borrowed yen money to Japan and then spark a global margin call.
It's fascinating because you have the dollar's value kind of collapsing, right? Which I guess that's the reverse part of the reverse carry
Yeah,
trade,
yeah,
right?
yeah, yeah.
Um,
And some people say, well, I don't understand that you're talking about deregulation as being, a positive or bullish, and what about Japan? It's like to your point, it's two different time frames. I think deregulation as a theme is a multi-year dynamic that's going to favor mid and small cap companies, right? And I think that does create one of the greatest relative rotations of money out of large caps we've ever seen. I think there's a real opportunity now for an argument to be made that now is the cycle for mid and small cap to really run under deregulation.
so I wanted to touch on that because you have a new ETF around deregulation, I'm very curious about that. I'm also a big believer in deregulation. I think that
You're an entrepreneur, you're a business owner. I mean, you of course.
Yeah, I mean it's brutal, and there's so many different layers to regulation. You have government regulation, but you also have quasi-government like FINRA rules and things like that. That it's very difficult to operate and build under a microscope and having to check 75 boxes to do anything.
Yep.
So I'm curious because there's been a lot of talk about deregulation. In terms of energy, in terms of manufacturing, in terms of environmental permits, and all kinds of stuff like that. But it seems to me, and maybe I'm wrong, that this would benefit the large caps more than the small and mid caps because they are just better positioned to take advantage of it, right? So I'm curious why you would focus on small and mid caps in that environment.
So okay,
Wouldn't Apple benefit more from deregulation than a small manufacturing firm?
so it's nuanced, and you're right, and partially it's sector specific, right? So regional banks should benefit much more from deregulation than large cap banks. Why? Because large cap banks, while they have multiple businesses and multiple customers that their types of customers are serving, the compliance does have overlap across all those business lines, and as a percentage of their earnings, it's relatively low, right? Because they have
Okay.
the ability to do it and they have the resources. Much smaller banks will be much more impacted in terms of their operating margin by deregulation because it's like there's a fixed amount of compliance you have to do dollar wise, right? And if you're smaller, it takes a bigger portion of your profit. So I think it's very much sector specific. The tech sector, broadly speaking, from our own studies on this, and we built out some AI mechanisms to screen for companies, high quality companies that would benefit the most from deregulation. Tech does not score very highly. So there are certain companies in tech that yes will benefit from deregulation. The effect would not be as significant on Apple versus, for example, as a non-tech example, an HVAC company where they don't have to worry about emissions now to the same extent because the EPA has been gutted, right? It's things like that, right, where it gets to be, I think, interesting from an alpha perspective. So yes, I do have several partners involved in this, but I have a new ETF that I'm hoping will launch basically second week of June. Ticker on that's going to be FMKT, free markets and active equity thematic type of product. And yes, Bitcoin is going to be a part of that because Bitcoin is the freest market of all.
Agreed. Agreed. Until quantum breaks it, and
Yeah,
then
yeah, well, that's a whole other. Yeah, then I'll make an ETF around that. But I think there's several others that compete against there. But but it's interesting because even in the context of Japan, let's bring. Which sounds weird. How do you combine the two?
okay.
So if we agree that deregulation sets the stage for more volatility, because free markets tend to be more volatile markets, right? Which is basically what Bitcoin is, right? Why is
Mhm.
Bitcoin volatile? It's a free market, right? So if we agree that deregulation also unleashes, on average, more volatility, well, if you're going to do that when your starting point for the global system is as much leverage as it is, then it could also spark all kinds of interesting tail events, sparked by Japan, sparked by any other number of things, suddenly because now the regulation is not dampening volatility the way it has the last several years.
Fascinating. Okay. Interesting. Well, I know we're running up against time. I really want to be respectful of your time. I know you have a hard stop. Thank you for joining. Is there anything you want to end off? Any bits of advice or anything you would tell a regular retail trader on how to survive the next year, 2, 3 years?
I say subscribe to TrendSpider. I'm
Oh,
not
thank
getting
you.
I'm not getting paid to say that. I am a fan of Dan's and everything that he's done, and I have a soft spot for any and everybody that's an entrepreneur. I don't know if people really, unless you're an entrepreneur building businesses, especially in a very bizarre industry like ours. And I say bizarre, that's a whole other podcast, why our industry is bizarre. It's hard for most people to appreciate the stress, the anxiety, the frustration, the sleepless nights, the passion, the hunger, the doubt that that happens to somebody trying to build something when they have a vision and they believe in it, right? And I think everybody that goes through that should be supported. So
I
if you're going to
appreciate
do anything as far as markets, it's more than just investing in a stock. It's investing in good people that are trying to take a chance in their own lives building these businesses to help you as the customer, right? And I think what you're doing with TrendSpider on that end is phenomenal.
I appreciate that. Would you, just going back to markets with the trader audience, would you, if you were telling somebody your views, would you say go long small caps, exit large caps? I'm just curious how
Yeah,
you
yeah, yeah.
position.
No. So look, what I would say is one is I'm very public against shorting. Right? It's like that line, markets are irrational longer than you can stay solvent. That's only
Oh, yeah.
true if you're short, right? Like markets can be irrational. If you're in cash, let it be irrational. You're still making some yield. If you're long, but you're long defensive, low beta sector, you're still making money. If you're long gold because you believe equities are rational, you're making money. It's shorting is the issue, right? So like it's less about what to do, it's more about what not to do. I don't
Fair.
believe I think shorting is far more dangerous than most people appreciate, right? Just because you
Agreed.
can be right on your thesis but still wrong, and because the
Treasury
market,
puts.
yeah, right, right, exactly, right, exactly. Right. So I think that's one thing, and then I think it's like everything else. Diversification means having things in your portfolio that you hate, okay? Which means if you're going to figure out what to be long, if you're nervous about things, make sure you have things which are not making you money now, which I know is a weird concept. But it's like if it's not making you money now, then you know you're diversified.
Yeah, one day it might when the rest of your
Yeah, of
portfolio
course.
isn't. So, well, cool. I think that's good advice. Michael, thank you again for hopping on. I really do appreciate you taking the time for this.